What if I told you that you could start collecting monthly dividend checks from stocks that cost less than a nice dinner out? Most people think dividend investing requires serious capital. They see dividend aristocrats trading at 200 plus per share and think it's not for them. Here's the reality. Some of the highest yielding dividend stocks in the market trade under $20. That means you can build a diversified dividend portfolio with less than $1,000. And today I'm going to show you exactly which ones. I'm Cole from Wealth Blueprint, and if you've ever felt like passive income was exclusive to the wealthy, this video is going to change that perspective completely. Before we dive in, quick reality check. These aren't meme stocks or microcaps. These are real companies, some over 100 years old, that are deliberately keeping their stock prices low while paying substantial dividends. It's actually a smart strategy they use. Let me break down how this works financially so you understand why this matters. If you invest $5,000 across dividend stocks with an average yield of 8%, you're looking at $400 per year in passive income. That's $33 per month. Scale that to $10,000 and you're hitting $800 per year. $20,000? You're at $1,600 annually. These numbers compound dramatically over time, but here's what's crazy. Most beginner investors never even try because they assume they need way more capital. That's literally leaving free money on the table. Okay, let's get into the actual stocks. Stock number 1, Maine, Gladstone Capital. This is a business development company, or BDC, and it's paying a 6.8% yield at current prices under $18. What makes this interesting? BDCs are required by law to distribute 90% of their taxable income to shareholders. That's not optional. That's the business model. Maine invests in middle-market companies, so you're basically getting paid to own a diverse portfolio of small business investments. The dividend is monthly, which is the real kicker. Most stocks pay quarterly. Monthly dividends, that's psychology working for you. You see the money hit your account 12 times per year instead of 4. Risk factor. BDCs can be volatile. The stock price fluctuates, but your dividend is protected by the business model structure. Stock 2, OE, Omega Healthcare Investors, trading around $19, yielding 8.4%. This is a healthcare real estate investment trust. Here's why REITs are perfect for under $20 dividend plays. They're required to distribute 90% of income to shareholders, just like BDCs. OHI owns and leases skilled nursing facilities and assisted living communities. The demographic tailwind here is insane. The population is aging, and these facilities are essential infrastructure. The monthly dividend is roughly 58 cents per share. Do the math. At $19 per share, that's 36% annually in dividends. Yes, you read that right. Risk factor. Healthcare policy changes could impact occupancy rates. Watch regulatory news. Stock 3. NRZ, New Residential Investment Corp., under $12, yielding over 10%. This is a mortgage REIT. I know mortgage REITs sound complicated, but strip away the jargon. They buy mortgage-backed securities and pay you the interest spread as dividends. Right now, this is insanely attractive because mortgage rates are elevated, which means the spreads are wide. The monthly dividend is roughly 28 cents per share. At $12 per share, you're looking at 28% annual yield. That's not a typo. Risk factor. This is the most interest rate sensitive pick on this list. If the Fed cuts rates aggressively, mortgage spreads compress, and the dividend could be reduced. That said, we're probably not looking at aggressive cuts until 2025. Stock 4, PSEC Prospect Capital, another BDC trading at $8, the cheapest on this list, yielding 11.4%. This company invests in middle market and upper middle market businesses. The monthly dividend is about 7 cents per share, which gives you that steady income stream. What I love about PSEC is the entry price. You can build a position with minimal capital and average down if prices dip. 100 shares costs less than $800. Risk factor. It's a concentrated play on private credit markets. If credit conditions deteriorate, the portfolio could be impacted. Stock 5. Gain, Gladstone Investment Corporation. Another BDC at $16, yielding 8.9%. Monthly dividend around 12 per share. This is more of a core holding versus a satellite position. It's less volatile than some of the mortgage REITs and has a cleaner balance sheet. The reason I'm stacking BDCs on this list is that they're the structure that guarantees high payouts. It's built into their regulatory framework. Now, here's the strategy piece that separates people who make money from dividend stocks versus people who don't. Don't go all in on one. This is critical. Build a ladder across these 5 positions. If you have $5,000, put $1,000 into each. Why? You're getting diversification across business development companies, healthcare REITs, and mortgage REITs. If one sector has an issue, the others steady your income. Second, reinvest dividends for the first year. Use your brokerage's DRIP feature, Dividend Reinvestment Plan. That $33 monthly from that $5,000 investment becomes $34 next month because you bought a fractional share with the dividend. It compounds. After 1 year, you'll have roughly $5,200 in principal generating dividends. That's free growth. Third, tax planning. These dividends are taxable income in your name if they're in a regular brokerage account. Consider opening a tax-advantaged account like an IRA if you haven't maxed it out. You can get $7,000 into a traditional or Roth IRA per year, completely tax-free on the dividends. Fourth, monitor quarterly earnings. These companies report results every 3 months. Watch for coverage ratios. That's how many times the dividend is covered by actual earnings. If coverage is deteriorating, that's a warning sign. Let me address the elephant in the room. Aren't high dividends risky? Not always. There's a difference between a sustainable 8% dividend and a suspicious 20% yield. Sustainable dividends are backed by actual business earnings, or in the case of BDCs and REITs, by regulatory requirements. What you're looking at here is the middle ground. These yields are high enough to matter, but grounded in actual business models. The real risk isn't the dividend itself, it's buying at the wrong time. If NRZ's stock price drops to $10, your yield jumps to 33%, but you could still lose principal. That's volatility. The dividend is likely safe, but your capital isn't immune to market movements. Here's the solution. Dollar cost average into these positions. Instead of dumping $5,000 in today, put in $1,000 per month for 5 months. This way, if prices drop 20%, you're buying more shares at lower prices, actually benefiting from the decline. Let's talk realistic expectations. If you start with $10,000 today across these 5 stocks, you're generating roughly $800 per year in passive income. That's $66 per month. Not life-changing yet. But here's the magic. If you reinvest those dividends for 5 years and the stock prices remain stable, your principal grows to approximately $12,500. Now you're generating $1,000 per year. Keep that going for 10 years, and you're looking at $15,000 in principal, generating $1,200 plus annually. Quit adding money, and that dividend stream funds itself indefinitely. That's the wealth blueprint. Small, consistent action over time compounds into serious passive income. Before you jump into your brokerage account and start buying, understand this. Past yield doesn't guarantee future yield. The Fed could raise rates further. Companies could cut dividends. Markets could crash. This is real investing, not a get-rich-quick scheme. But if you're willing to research, monitor your positions quarterly, and stick with a 5 to 10-year horizon, this strategy absolutely works. Start small, $1,000. See how it feels to get monthly dividend deposits. Prove to yourself that passive income is real. Then scale. That's how ordinary people build wealth. If this video helped you see dividend investment,